Operating revenues hit 61.04 billion new Taiwan dollars this quarter. Net income. That saw a massive spike of 108.1% year over year.
Yeah, that translates to an EPS of 1.29 NTD.
Right, so welcome to today's deep dive. We are jumping straight into the numbers today for United Microelectronics Corporation, or UMC, looking at their first quarter 2026 financial results.
And just for you listening, our sources for this are UMC's official Q1 2026 earnings presentation deck, along with their consolidated financial statements, both dated April 29, 2026.
Exactly. And our mission today is really to cut through all the dense financial jargon. We want to uncover the real story behind UMC's numbers and understand the true health of this massive semiconductor foundry. We're going to look way beyond that top-line revenue to see exactly where their growth is coming from and what headwinds they might be facing.
Which is super important right now because those headline numbers we just mentioned, they paint a really confusing picture if you just take them at face value.
Oh, totally. I mean, let's look at the scoreboard for Q1 2026. Like I said, operating revenues hit 61.04 billion NTD, which is actually down slightly quarter over quarter by 1.2%, but up 5.5% year over year.
Right, a modest gain. And their gross profit margin sat at 29.2%. That's down from 30.7% in Q4 of 2025, but still up from the 26.7% we saw a year ago.
Yeah, but here's where the math just stops making sense. Net income was 16.17 billion NTD attributable to the parent company.
Which is huge.
It's massive. That's an EPS of 1.29 NTD, or about 0.204 US dollars per American depositary share. The crucial thing here is that net income is up a staggering 108.1% year over year. And it's up 61.2% sequentially from Q4.
Yeah, it's wild.
It really is. I mean, think about it like this. It's like you getting a modest 5% raise at your job, but somehow by the end of the years, your bank account balance has literally doubled. Like, if operating revenue only nudged up 5.5%, what on earth is driving a 108% spike in net income?
Well, the secret is entirely in the non-operating income. If you dig into the consolidated statements, UMC generated 5.36 billion NTD in net non-operating income.
Wait, really? 5 billion?
Yeah, 5.36 billion. And to give you context, a year ago in Q1 2025, they had a loss of 439 million in that same category.
Oh, wow. That's a massive swing.
It's a completely different ballgame. So if we break that down, 2.81 billion of that came from their share of profits from associates and joint ventures.
Okay, got it.
And then there's another 2.11 billion from just general other gains and losses. So what this shows us is that UMC isn't just making money manufacturing chips. Their strategic investments and their joint ventures are paying off heavily.
Right, so they're playing the investment game just as well as the manufacturing game.
Exactly. It padded their bottom line in a way that core operations just couldn't this quarter.
So, okay, if clever investments and these JVs are padding the bottom line, how is the actual core business of chip manufacturing doing? Like, who is actually buying wafers from UMC right now?
That is where we see a really dramatic shift. They outline this clearly in the presentation deck. Their customer demographics are changing fast.
How so?
Fabless customers, companies that design chips but don't manufacture them, they jump to 86% of UMC's total sales.
Wow, 86%.
Yeah, up from 80% just in Q4 2025. And on the flip side, IDMs, or integrated device manufacturers, dropped to 14% from 20%.
Okay, let me make sure I'm wrapping my head around this. Let's use an analogy.
Sure.
Think of fabless companies as, like, architects who design a house, but they don't own any hammers or saws.
Right. Good analogy.
And the IDMs, they are the full-stack construction companies. They design it and build it. So why is UMC suddenly building so many more houses for the architects instead of taking on overflow work from the full-stack builders?
Well, you have to connect that shift to the applications they're building for. Look at the end-use data. Consumer applications grew to 32% of their business, up from 28%. Meanwhile, communication apps dropped to 39% from 42%. Computer applications just stayed flat at 12%.
So it's all about consumer tech right now.
Exactly. The rise in consumer electronics demand is heavily driven by these fabless designers. Think about smart home gadgets, wearables, all these fast-moving consumer products.
Oh, right. Those companies don't want to spend billions building a silicon fab.
They can't afford to. It would destroy their margins. So they outsource completely to UMC. This puts UMC in a highly leveraged position to benefit directly from consumer tech cycles.
That makes a lot of sense. And the geographic data backs that up too, right?
Yep. Asia dominates at 65% of sales. North America is holding steady at 21%. Europe is sitting at 9%. And Japan is at 5%.
Which perfectly maps to the Asian consumer electronics assembly hubs. Like, UMC is just deeply embedded in that whole ecosystem.
They absolutely are.
Okay, so to serve all these fables architects who are dreaming up the next big consumer gadget, UMC obviously needs factory capacity. Let's talk about how their factories are running and, more importantly, where they're spending their cash.
Right. The capacity and utilization metrics are pretty telling this quarter.
Yeah, so looking at the deck, their factories ran at 79% utilization in Q1 2026, which honestly is a really solid recovery from the 69% they were at in Q1 of 2025.
Definitely a healthy bounce back.
And they shipped 1.021 million 12-inch equivalent wafers, which is a ton of silicon.
It is, but their total capacity for Q1 was 1.283 million wafers, and they expect that to grow a bit to 1.305 million in Q2.
Right. And here's the part that I really want to dig into, because UMC announced a 2026 foundry capital expenditure plan, their capex of $1.5 billion US.
A massive bet.
But wait, they are running at 79% capacity.
Yeah.
That means 21% of their machines are essentially sitting idle right now.
Yep, 21% slack in the system.
So to go back to analogies, that's like an airline flying planes with a fifth of the seats completely empty and then deciding to commit $1.5 billion to buy more planes right now. Like, why? Why do that?
It sounds crazy when you phrase it like that, but in the semiconductor industry, you do not invest for today's utilization. You invest for tomorrow's technology nodes.
Okay, explain that.
Look at the specific SKU of that capex. 90% of that $1.5 billion is dedicated strictly to 12-inch wafers. Only 10% is going to the older 8-inch technology.
Oh, wow. So they are basically abandoning the 8-inch development.
Effectively, yes. UMC is aggressively future-proofing its foundries. Those fabless designers we talked about, they're pushing for better power efficiency, smaller chips, more advanced tech for consumer devices.
And you just get way better unit economics on a 12-inch wafer, right?
Exactly. The surface area is more than double an 8-inch wafer. You get more usable dies, less waste at the edges.
So the empty seats on the airplane are basically in the old, outdated propeller planes.
Exactly. And they're buying new jets because that's what the customers want to fly on next year.
That makes perfect sense.
Yeah.
But still, $1.5 billion is a massive, massive bet on the future. And that brings us to the risks. What does UMC's management actually believe could derail this whole expansion plan?
Well, they are legally required to disclose these things, and their forward-looking statements in the presentation outline some very real vulnerabilities.
Yeah, and before we dive into this first one, we really need to set the stage for you listening. We are going to talk about geopolitics, and we want to explicitly state that we are taking no political sides here, neither left-wing nor right-wing. We are strictly and completely impartially reporting the business risks exactly as UMC's management outlined them in their filings.
Right. This isn't commentary. It's just what is in the report. And what the report explicitly mentions is the geopolitical conflict between the U.S., China, and Taiwan.
Which is, frankly, unavoidable when you're headquartered in Taiwan.
Exactly. The supply chain for semiconductors is incredibly sensitive. Any new tariffs, trade restrictions, or export controls on the equipment they need to build those 12-inch fabs could be a major disruption.
Right. If you can't buy the lithography machines, you can't expand your fab. It's that simple.
Yep. And beyond the geopolitical risks, they also highlight macroeconomic headwinds.
Like cyclical downturns.
Right. We just established they are 86% reliant on fabless customers, pushing hard into consumer applications.
Which is a super elastic market.
Very elastic. If there's a global recession or even just high inflation, consumer spending on smart gadgets drops instantly. And global supply chain disruptions or intense competition could squeeze them even further.
And when consumer demand drops, those fabless companies just halt their orders, leaving UMC with idle 12-inch machines that they just paid $1.5 billion for.
And those machines depreciate fast, whether they are running or not.
Okay, and there was one more big risk they highlighted, which was currency fluctuation, right?
Yeah, foreign exchange rates. The Q1 report noted they use an exchange rate of 31.63 NTD per US dollar.
Which matters, because they sell their wafers in US dollars on the global market, but they pay their local engineers, their utilities, and their taxes in new Taiwan dollars.
Exactly. If the NTD strengthens too much against the USD, their margins get crushed without a single factory metric changing.
It's just poof, profits vanish in the exchange rate.
Pretty much.
So, knowing all these risks, the geopolitics, the macro cycles, the currency swings, I was looking at their balance sheet, and UMC is sitting on over 109 billion NTD in cash and cash equivalents.
It's a huge pile of cash.
It is. Are they just hoarding this cash specifically to weather these exact storms?
Oh, absolutely. Maintaining massive liquidity is a standard defense mechanism in the semiconductor industry. It is a hyper-cyclical and incredibly capital-intensive business.
So that 109 billion is basically their shock absorber.
Exactly. When you have these identified geopolitical and supply chain vulnerabilities, plus a $1.5 billion capex bill coming due, you cannot operate on thin ice. You need that cash to survive the down cycles so you can be ready for the upswings.
Wow. Okay, so let's briefly recap the core themes for you listening today. UMC delivered a really solid quarter with modest revenue growth, but an absolute explosion in net income.
Driven almost entirely by smart strategic investments in JVs.
Right. And operationally, they're leaning heavily into Fable's customers in consumer tech. They are betting $1.5 billion primarily on advanced 12-inch wafer capacity, all while keeping a massive cash fortress to defend against geopolitical and cyclical risks.
That really is the high-level summary of where UMC is at right now.
As we wrapped up, I want to leave you with a final thought to ponder. We talked a lot about that heavy 90% capex focus on 12-inch wafers and their increasing reliance on these Fable's customers.
Right.
What happens if the fabless market suddenly pivots its architecture? Like, what if consumer demand drops or chip design changes radically? Are foundries like UMC becoming so specialized and so intertwined with other designers' success that they're essentially at the mercy of their customers' R&D departments?
It's a really interesting question because they don't control the design anymore.
Exactly. If the designers guess wrong, UMC is left holding a very expensive $1.5 billion bag. It's definitely something to keep an eye on in the coming quarters. Well, thank you for joining us for this deep dive into UMC. Make sure to follow the show for daily earnings coverage, and we will catch you next time.